Welcome to the College Investor Audio Show, where we talk about the biggest issues impacting millennial money, from student loan debt to side hustles to building wealth. We will show you how to get out of debt so that you can build real wealth for the future.
You hear a lot about a couple of things when you listen to the College Investor Audio Show and also check out thecollegeinvestor.com. You hear about mutual funds and ETFs. That can be a confusing couple of terms for some people, so we thought, hey, let's do a podcast on it. Today, mutual funds versus ETFs and understanding the difference. Let's get right to it. So mutual funds and ETFs might sound like the same thing to a lot of investors, but there are a few important differences between these two investment vehicles. Fees, types of investments available, dividend payouts, availability based on account type, all come into play when choosing between mutual funds and ETFs. First, what is a mutual fund? Mutual funds are investment funds that are proxies for some index or sector. For example, if you want to invest in the S&P 500, you can find an S&P 500 fund to invest in. It will track the S&P 500, which means it uses the S&P 500 as a benchmark. In other words, the fund should perform similarly to the S&P 500. Besides indexes like the S&P 500, Russell 2000, or NASDAQ, mutual funds can invest in sectors such as energy, retail, tech, real estate, metals, and lots more. Mutual funds are also popular for investing in bonds. Bond mutual funds are simply called bond funds. So mutual funds allow investors to purchase partial shares or fund units. For a mutual fund trading at $1,000, an investor can purchase $800 worth of the fund. In a way, it's a fractional share. Purchasing fund units lets investors focus on dollar amounts invested rather than the number of shares. Looking at the dollar amount invested instead of the number of shares is great for retirement accounts. Retirement account contributions generally come in at some round dollar amount, such as $1,000, $3,000, or $5,000. That money can then invest in a fund without worrying about how many shares are needed. Mutual fund prices aren't like stock prices. You can look up a stock at any point during the day and see its real-time price. Mutual fund prices are only known at the end of the day, and you are usually viewing the previous day's price. The price of a mutual fund is called the NAV, or net asset value. So going back to the $1,000 example that we mentioned, that's the fund's NAV. Mutual funds also come with various fees. Now, fund fees have been falling over the last few years, though, which is good news. Some fund companies have even eliminated certain fees. The most common fee is a management fee or expense ratio, ranging from near 0 to 2% of your investment in the fund. Some funds will charge more than 2%, but given the large universe of funds to choose from, there isn't much reason to pick a fund with a high expense ratio. If you invest in your employer's 401k, there may not be much to choose from. Fund fees shouldn't be more than 0.5%, but of course, that will depend on the funds offered by your employer's 401k. 401k plans often don't provide much in the way of variety either. If you're getting a match from your employer, it can still be worth it even with a higher expense ratio fund. There is also the load fee, which is one fee that many fund companies have removed. Given how easy it is to remove load fees, there's really no reason to choose funds that still charge them. One thing to note too, many mutual funds pay dividends, which also can help offset some of the fund's fees. All right, that wraps up mutual funds. Now let's take a quick snapshot into what is an ETF. ETF stands for Exchange Traded Fund. It is similar to a mutual fund, except you can trade it intraday, just like a stock. But unlike a mutual fund, its pricing is real-time. This aspect of ETFs might be appealing to those who are active with their investments, since ETFs allow you to better time the market. Like mutual funds, many ETFs pay dividends. Fees on ETFs usually come in the form of an expense ratio only. Also, ETFs are set up to follow indexes, sectors, and bonds. Because ETF prices are discoverable intraday, they must be purchased in shares. ETF shares can't be split. For example, if an ETF is trading at $80 and you want to invest $500, that is impossible. since it would result in buying 6.25 shares of the ETF. Instead, you'd have to buy $480 worth of the ETF or 6 shares. Okay, so now you have the basics down. Now it's like, how do I choose between the two? Now, if you have a 401k, you're probably restricted to mutual funds only, since they allow for dollar-based contributions rather than shares. For non-401k accounts, mutual funds offer an advantage over ETFs regarding automatic investing. For example, let's say you want to contribute $500 a month into your Roth IRA. That $500 will be invested into a mutual fund. That type of investing isn't possible if you invest in an ETF, since an exact number of shares must be purchased. There are differences in the expense ratios and dividend payouts between mutual funds and ETFs, which can be a deciding factor when choosing between the two. Additionally, a specific mutual fund or ETF, but not both, may invest in one particular sector that you're looking for. The choice between a mutual fund and ETF is not exclusive. Nothing says you can't have both in your account, if the account type allows for it. And that is our show for today. Yes, there is so much more to learn about investing than just these two things in the quick snapshot we gave you today. But I hope that was helpful. And if you want to know more about this stuff, oh my, do we have the resources for you. It's thecollegeinvestor.com. Check it out. We have all kinds of reviews, lots and lots of links and resources, all for free. thecollegeinvestor.com, and some pretty cool discounts and deals that you can do too, just through the website. Thanks again for being a part of this today, and we'll talk to you again very soon.